Going, the stock on our radar right now is Quess Corp. Now, if you remember, the company had earlier announced at the beginning of the year that they plan to demerge their business into 3 entities. Now, the latest update is that NSE and BSE have issued a no adverse observation or no objection certificate to their demerger plans. So now the company will go ahead and approach the NCLT Bangalore. So basically, it's a step forward, a positive step forward in the company's demerger progress. Kamal Hoda, the Group CFO of Quess Corp, is now with us on the show. Thank you very much for joining in. This is Rima here. So can you give us some timelines on the demerger, the next steps, and when do you think the 3 entities would be listed, to your mind?
Sure. Good morning, Rima, and good morning to your viewers. As you mentioned, we have recently received the BSE and the NSE clearance, as well as the secured creditors clearance. So that's a major milestone. And the demerger, we are making significant progress with our demerger process on the back of steady sales growth, consistent financial results across all our platforms, and strengthening of our leadership positions. If I talk about timelines, last week we have already applied to NCLT, and this process usually, should take 6 to 7 months. And we are hopeful that by end of this financial year, we should be able to complete the demerger process, post which these three separate companies should get listed.
At the end of FY25, you're hopeful that the demerger process should get completed, and by Q1 of FY26, can we assume the 3 entities would be listed separately?
Yes, that's our internal timelines and estimates as well. And like I said, there's significant traction that's happening in the organization right now towards demerger. We've recently strengthened our leadership positions for the BPM business, where we are also targeting grow from a $350 million base of revenue to $1 billion over next 4 to 5 years. So yes, all looks on track for Q1 of next financial year.
Okay. Mr. Hoda, good morning, and thank you for speaking to CNBC-TV18. Well, can you tell us, your main business is workforce management, correct? What would the margin profile and revenue growth be for FY25? I think you're sitting at about 2.6% EBITDA margins, and last year you had a growth of around 13.5%. So can you tell us what kind of growth are you looking at in FY25?
Sure. See, we started this year, Q1, fantastically for us. We did around 30,000 plus headcount additions at the start of this financial year. If you see last year, full year, the revenue grew around 11% and the EBITDA grew around 18% at an overall level. This year, we are confident of growing a good double-digit growth in revenue, and we should be able to repeat our EBITDA growth performance year on year from last year in the range of 18 to 20%. When you speak about workforce management, the festive season has just begun with Raksha Bandhan today, and we are seeing good, increase, almost a 20% increase in our open mandates, which is around 40,000 now in last 3 months. And the sectors which are primarily hiring right now is e-commerce, modern age manufacturing, and BFSI. So we are very confident of doing a good double-digit growth in revenue, a healthy double-digit growth in revenue, and 18 to 20% growth in EBITDA for this financial year.
So you're saying for FY25, a healthy double-digit growth in revenues is what you've done. But can you just give us the numbers for FY24? What did you close the year with in terms of revenue growth, as well as what was your margin profile?
Sure. So last year the revenue growth was, as I said, 11%, and EBITDA margin we were around 3.6, 3.7% on a full year basis. We had guided the market that we should be close to around 4% this year, and we look to be on track to reach to the 4% milestone by end of Q2 or early Q3 this year.
Okay, so that's on one of the businesses, workforce management. Now, the second demerged entity is going to be Digiti. Can you tell us a little bit more about Digiti? What is the business that it covers, and what will be the financial profile, the revenues, the margins, and the revenue growth investors should expect from Digiti?
Sure. Just a correction, the workforce, the numbers that I gave were the consolidated Quess level for this year at 4% margin. Workforce management, the EBITDA margin is around 2.6% right now, and we expect the margins to move more near towards 3% as we progress towards this year. Maybe at the end of Q3, we should be seeing around 2.7 to 2.8% margin. Moving to Digiti, which is primarily into the BPM space as well as the HRO space. We've got a $350 million business with around 18% EBITDA margin that we are operating right now. We are among, let's say, the top 3 players as far as the BPM space is concerned in the country, and obviously the largest player in the payroll processing space. So in that business, like I mentioned, we've been strengthening leadership, and we believe that we should be able to grow that business over long term from a $350 million business to a $1 billion business.
Okay. And can you tell us a little bit more about the third entity, which will include the operating asset management, which is basically facilities management, and you also have the founded business. So this third entity, can you give us what is the current revenue scale of this company with margins? And founded, I believe, is loss-making. So once it turns around, what could be the margin profile of this company?
Sure. So the third business is the legal entity called Bluspring Enterprises, which will hold primarily 3 businesses: the facility management business, the industrial asset business, and our investments in Founded. The facility space and the asset maintenance space on a consolidated basis is around 3,500 crores of top line on an annualized basis, operating at an industry benchmark of around 5% margins. There is opportunity to grow these margins further 10%. That's what the target is this year, to increase the margins from 5% and move towards 5.3, 5.4% levels. As far as Founded is concerned, Founded should be a break-even for this year in terms of the EBITDA. The annual revenue run rate Founded, we are expecting to cross around 200 crores. At that level, Founded should be a break-even business. So, we have from FY23, where we did around 95 crores of investments and cash burn in business, we brought down our losses on the back of good steady sales growth last year to around 55 crores in Founded. And this year we are expecting from a negative 55 crores to go to zero. So that's what Founded is going to do this year.
We will let you go on that note. Mr. Hoda, thanks a lot for joining in and speaking to CNBC-TV18. That is the word coming in from Quess Corp. Well, for the market, it's still very quiet, but there are so many stocks that are buzzing around. So we'll do one thing. We'll take a quick break. On the other side, we'll